Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. We're getting great feedback on our podcast, especially on the range of our guests. We've had policymakers like the Bank of England's Lord Mervyn King, the former Reserve Bank of India and Chief Economist of the IMF, Raghu Rajan, and the former Finance Minister and Central Bank Governor of Argentina, Alfonso Prat. We've also had investors like Jim Leitner, Edward Mizrahi, and Sharab Ahmed. And we've had economists like Morgan Stanley's Stephen Roach and the Financial Times' Martin Wolf. So make sure to subscribe to the podcast show to catch the latest episodes. You can do that on Apple or Spotify or any of the popular podcast platforms. I'd also like to remind you that we have excellent macro analysis on the macrohive.com site. This week, we feature articles on the potential positives of MMT, how equities trade around US elections, and why the Chinese yuan could stay strong. You can access all this content, including the archive and Slack channel, for the weekly price of a few cappuccinos. Macro Hive is fast becoming one of the must-have subscriptions for people in the financial sector, so make sure to sign up. I also get some requests on whether we offer discounts for students or for people in low-income countries. The answer is yes. Just email me at bilal@macrohive.com and I can tell you more. I mentioned our excellent slate of guests, and this episode is no different. I have David Beckworth, who is the host of one of my favorite economics podcasts, Macro Musings. Outside of his show, David is a senior research fellow at the Mercatus Center at George Mason University, and he was a former international economist at the US Treasury. He's the author of Boom and Bust Banking, The Causes and Cures of the Great Recession. His research primarily focuses on monetary policy, and he has advised congressional staffers on policy too. On to our conversation. So welcome, David, to our podcast. First of all, I have to say I'm a huge fan of your show, Macro Musings. I feel as though I've known you for years, although this is our first time to speak in person. So I just wanted to first congratulate you on your podcast show and also welcome you to our podcast show.
Well, thank you for having me, and thank you for listening for 4 years, I believe now. So it's been a fun ride, and glad to have fans like you.
Great. I thought we'd jump straight into the heart of the discussion. You know, I know you're a big Fed watcher and follower, and you have lots of ideas of how monetary policy should be conducted. And the issue, of course, we've had lots of extremes, and the Fed is part of those extremes in terms of the scale of its policies it conducted over the early part of the COVID period. I just wanted to get your take on their measures they took and which parts you agreed with, which parts you disagreed with.
Yeah, well, first off, I was pleasantly surprised to see them act so quickly compared to 2008. They were a lot slower, a lot more deliberation, but this time around, they were very quick to respond, very aggressive. And there were definitely programs that I liked more than others. So I'll list the ones that I think they did correctly, and that is the liquidity facilities. And I'll draw a line between liquidity facilities and what I would call credit facilities. But the liquidity facilities are those like the primary dealer credit facility, the money market fund facilities, those that really go to backstopping the dollar system around the world. The dollar swap line is another example, commercial paper facilities. And the Fed had to step into it. I mean, effectively, it was stepping in and backing up the shadow banking system, all the dollar funding out there beyond traditional U.S. banking. And that's its role is to be a market maker, a lender of last resort. And it just so happens that its area now is the world because of the scope of shadow banking around the world. So I think it had to do that. And I think it did it well. I mean, it stepped in. We've seen all indicators of market stress have gone down, spreads have compressed, all those great things. This does, of course, raise a question if this is the best way to handle shadow banking over the long run. Maybe there's some regulation, something we can do. And that's a whole different conversation. But given that we're here, I thought the Fed did really well, stepping in quickly in a timely fashion. Where I'm a little less comfortable, yet I understand why they did it, but I would like to see things done differently is with the credit facilities. So things like the bond facilities, the primary and secondary market bond facilities, also Main Street facilities, the municipal market facilities. In a way, now again, they might argue those are actually liquidity facilities, but I see them more as credit facilities. You're picking winners and losers. And it's particularly poignant with the bond market facility. I mean, who's going to be able to receive funding or support, liquidity support from the bond facilities? It's going to be big corporations. Smaller businesses aren't going to get the same benefits. no matter how hard they try, they're going to be picking winners and losers. And you see this, you see political blowback, you see people on the left wanting to change the conditions, whether it's better access for state governments, local governments, or smaller businesses. And I think they're messing with a hornet's nest here. And there might be some challenges down the road to their independence because of it. Now, I said I understand why they did it. I feel like they were the only institution in town that could respond quickly and nimbly. But I think we're all going to be disappointed because they can't respond as well as people have hoped. Just off the bat, those two things there. Liquidity facility, good job. Credit facility, let's maybe rethink it for next time.
And just on the credit facilities, two things. One is, are you concerned about Fed independence and the growing connection between the Treasury and the central bank and decision-making there? And then second one is, are these credit facilities any different from just the standard QE? Because many people would argue that them buying Treasuries also advantaged, large corporations and those already with wealth and so on.
Yeah, let me answer the second question first. I think in some ways you could make that argument, but that's a reason just to stick with QE. Just go through a policy that's accepted, that's viewed less potentially dangerous for the Fed's independence down the road. And you're right, there are questions about how QE has affected wealth disparities and stuff like that. But let's don't expand it and make it potentially a bigger minefield for the Fed. Let's keep it focused. So I think a lot of what the Fed could do for the bond market, for the municipal market, could be done through traditional QE and these other liquidity facilities. On your first question, though, in terms of independence, I do think this is a big deal because the Fed is really good at what it does in terms of maintaining, price stability. I mean, it has some issues with full employment, but in order to do that, it really needs to be removed from the political process. And everything I've seen shows that there's the unease, the disappointment of what the Fed has done in the credit facilities is opening a Pandora's box. Now, maybe we'll get to next year and this will all be a past memory and they'll be back to the way they were before. But I do think by the Fed going into areas it normally doesn't do and not performing well, it creates a disappointment because there are winners and losers, and those losers are going to push hard for the Fed to do more. And we see that already with, the Fed should be buying green bonds. Maybe it should be targeting different types of unemployment rates. And somewhere they're going to have to draw the line, and you're making it a gray area. So, yeah, I do think it's a big deal moving forward.
Do you think this notion that the Fed or central banks are independent, maybe we're overstating their independence? There always has been political interference. If you go back in the case of the US with Arthur Burns or even before that, when you see the minutes and the influence that presidents had on central bankers, do you think we are a bit too optimistic about their independence?
That's a fair point. There's no doubt it's political appointments, the decisions. There's always going to be politics. And I actually think Jay Powell is good on this front. I think he's an exceptional chairman because he knows how to play that game. He's someone, like he said, he's going to wear out the carpets on Capitol Hill. Whereas the previous two chairs before him, they were good economists, but I don't think they had the political smarts that he has. So yes, it's always the case that there's politics and sometimes more than others. And these are just norms, right? I mean, Bill Clinton, I think, really is the one who kind of set a norm that we're going to step back and let the Fed do its thing. So yeah, it comes in waves and maybe we're at a point where we're going to see it less of it. But I do think it's important because of fiscal dominance. If the Fed is highly politicized, it makes it easier for the Treasury and Congress to say, we're going to call the shots for you. The whole point of having an independent Fed, even if it is partly a fiction, is to at least tie the hands of Congress. Congress can say, look, I would love to help you out, constituents, get the economy roaring hot, but it's the central bank over there doing its thing. And I think it's a nice separation. It's a useful one. Has the Fed maybe not done enough? Yeah, I mean, as you know, I'm very critical of the past decade, the Fed's performance, but I don't want to swing so far the other way that everything's being decided by Treasury and Congress.
And in terms of potential policy steps that the Fed could pursue, one obviously is negative rates, so go below the zero bound. Other countries have done that, Europe, particularly Japan as well. The other is yield curve control, which many market participants are focusing on now as the next step for the Fed. What's your take on those as policy options and the probability of those being used by the Fed?
Well, negative rates, I think it's pretty clear that the Fed's not going to touch them unless it's forced to. I think in theory, they're fine. In practice, it's a different matter. If you get to the point where negative rates are needed, you could tell a story theoretically where the Fed is able to preserve interest rate margins for banks. One of the big challenges of doing negative rates is you harm bank profitability. You always hear this critique. You could think in theory, I mean, think of a bank. A bank is funding short-term and investing or lending long-term, right? You want to preserve a spread between those two funding and lending costs. Well, you can imagine a world where the central bank is able to lower both of those margins equally, proportionally, and you could be well into negative territory and banks are still profitable. That would be the theoretical argument, I think. In practice, it's much more difficult to do. I know the ECB has tried something like the TLTROs, which is kind of along that path. But I think in practice, it's just difficult to implement that, to stabilize net interest margins. Secondly, it's politically difficult as well. It's hard for many people to understand, why are we doing negative interest rates? It seems so abnormal. Even if you and I would think, well, in certain worlds, it would be fine. But the political toxicity and the difficulties of doing it efficiently, I think, will make it unlikely going forward.
And I think it's also interesting that many of the central banks that did have negative rates didn't really focus on it this time around over COVID. They didn't go deeper into negative. So the people who've done it seem to be saying, actually, let's just leave that alone and let's use other policies.
Yeah, that's a great point. And yield curve, I guess, was the other question here. It's a little unclear, although recent minutes suggest the Fed's less excited than they seem to be of previous minutes. I mean, it seems to be a bit of a roller coaster ride on this issue. I think it's something they could resort to if, again, things get worse, like the Fed might resort to negative rates if they get pushed into it. Hopefully the recovery will take hold. I mean, there are some worrying signs about the recovery, but if things get really bad, maybe, yes, it's on the table. What do I think about it? I think it's a nice, effective way, backdoor way to coordinate monetary policy and fiscal policy. If you really need that extra oomph, that extra punch, this is definitely a way to do it, because effectively the Fed is just supporting treasuries unofficially by setting a price for them, which they did during World War II. And we know the famous story, the Fed Accord, where it ended. So I think it would be an effective way if you really want to do that. Challenges would be, again, the Fed is going to get nervous if it requires a bigger balance sheet. Now, I know the argument is, well, if it's a credible yield curve control, they won't need to have a big balance sheet, I think like Australia. But I think in order to get credibility in the first place, always takes concrete steps. You don't magically get credibility, you always earn it. In anything in life, you have to earn credibility. And that may mean the Fed has to expand its balance sheet a few months, maybe a year. And the Fed probably doesn't want to do that given it's already fairly large. So I think that's something they worry about. And then the other big challenge is always coming out of it. How do you do that without gumming up the markets or jarring the markets, or there'd be somebody trying to make money off of that move? How would the Fed say, oh, we're ending it? I mean, someone's going to try to guess it, play it. So there's a whole lot of tricky issues, I think, in washing your hands when you're done with yield curve control. I think for those two reasons, probably the Fed's reluctant to get involved.
Yeah, that makes sense. You have that in currency markets when you have a currency peg. You know, at some point it's unsustainable, and then you have to take on the market, and it's always messy.
Yeah, and I think especially with treasuries, I think it's one thing, you know, for some of these other countries to think about doing yield curve control, but man, you're dealing with the treasury market. I mean, you're playing against the world here, the biggest market. So look, the Fed in theory could buy up all the debt if it had to, but the Fed doesn't really want to go down there. That's close to 20 trillion or so. So that's probably a bit too far for the Fed in its comfort zone, unless again we end up in a bad place.
Now, the alternative tack the Fed could take, and they are, they're reviewing the whole framework, and we'll get, I guess, a read on that from the upcoming sort of Jackson Hole speech by Powell, which we're recording before that, so we'll see what that is. But, what's your take on some of these proposals around average inflation targeting and price level targeting, and one of your favorite topics, nominal GDP targeting? So, rather than focusing on the tools, let's focus on the target, and there's different versions of all of these. How do you go through them and think about them?
Well, first, let me say thank you for listening for 4 years as I continue to promote nominal GDP level targeting. I figured it would have turned some people off by now, but you're right. That's been my soapbox issue. What I think about average inflation targeting, price level targeting, which are much more likely than what I want. First, they're very similar. I think in practice, you wouldn't know much difference. And again, in theory, they might be different. So a price level target says they'll make up for past misses. If you're targeting 2% inflation and you undershoot, say 0% 1 year, then you've got to not only hit your 2% plus what you missed the previous year. Average inflation targeting does the same thing. It's just a question of the horizon. So a price level target says you have to fully make up for all your past misses and get back up to where you should be. An average inflation targeting might have a shorter window. It might say, oh, well, only the misses of the past 2 or 3 years. So I think in practice will probably be similar, but you can see where they're different. I would say that it's a step in the right direction. If they have a truly credible one, which I'm not sure they will, but if it's credible, they actually can do makeup policy through average inflation targeting, I think the world will be a better place. So let me just quickly summarize why I think makeup policy is important and the way I think about makeup policy. So the Fed describes it as an opportunity to let inflation temporarily go above its target. And that's probably true. That will happen during makeup policy. But the reason it's doing that, and to me, this is the proper way to sell it, is that you're running the economy hot. You want to temporarily run the economy hot to get back up to its full potential, to get up to where it should have been had there been no crisis, no recession. And the example I love to use is imagine the economy is like traffic and you're on a road and you have a traffic jam and you're stuck and you had planned a trip at a certain speed. Well, now you've had some time where you're sitting still. That's the recession. To get back on your journey and make it at the designated time, you've actually got to go faster than the speed limit, faster than the speed you'd originally targeted. So you've got to speed up and go faster than what's normal. Eventually, you can go back down to the speed limit. That's what makeup policy does. It temporarily runs the economy hot. It probably will lead to some temporary inflation higher than target. But you're getting incomes back up, you're getting spending back up, and we want that. And what we saw, across advanced economies, Japan, ECB, the Fed over the last crisis, it took forever to get a recovery. And this is a way to expedite that. Let's get it done quickly and do it in a structured way so it's not ad hoc. You can always run the economy hot within a fiscal and monetary policy firepower, but do it in a systematic way. And so that's what I see makeup policy is. You're revving up incomes and spending and returning to where they should have been. The Fed's going to approach this from an average inflation targeting framework. I, of course, would do it from a nominal GDP or nominal income framework, but that's how I see it.
Obviously there's always a lot of resistance to change of anything with a central bank. I remember, I think a year or two ago that Ben Bernanke talked about price level targeting, but he kind of talked about temporary price level targeting when you get close to the zero bound. Do you think that's being too cute if you do a temporary one when you're in extreme circumstances?
So you're right. You'd only do makeup policy when you're at the zero lower bound, or only when you fall below because of like a deep recession. His concern was on the other side. What if you had a boom when you go above the price level target? He didn't want to have a recession to bring it back down. It's like an asymmetric price level. You're only going to do makeup when you're below. And he has a good reason for worrying about it, because if you have a price level target and you have a negative supply shock, a big oil shock or another virus, it has the potential of raising prices temporarily. And he says, look, we need to be able to see through that. And I completely agree. So his solution is, let's just do makeup policy when we fall below and not do it above. And you know what? I'm sympathetic to that. And there's actually a name for that. It's called nominal GDP targeting. What he's arguing is effectively what a nominal GDP target would do. A nominal GDP target also sees through supply shocks. And the only reason you would have, a zero lower bound, a drop below the price level target is because of collapse in demand. And that's what nominal GDP targeting restores demand. It stabilizes and restores demand. So what he's proposing, if that's what it takes, some fancy language, I'm all for it. If we get closer to this world. Again, average inflation targeting is also a step in that direction. And I really don't think the Fed, if they do this, would actually cause a recession to lower. If inflation's been running above target, I really believe they won't do it. So I think maybe what we will see, again, if we have a truly credible average inflation targeting, it might look a lot like a Bernanke temporary price level target.
And actually, your point about supply shocks is a very valid one. COVID, I guess, is both a supply and a demand shock. And I suppose if you are targeting whatever variation of inflation, you do have that problem of how do you cope with a negative supply shock?
Yeah, absolutely. And I think like you're in the UK, it's a much bigger issue over there because you're a lot more of an open economy. This happens a lot more there. Tax, you have change in tax policy. Anything that affects the productive capacity of the economy, the cost structure is going to temporarily cause inflation to go up. And you want to see through that. That's not what monetary policy can solve or meaningfully address. And nominal GDP targeting, in my view, is the easiest way to do that. You say, look, we're just going to keep our eyes laser focused on total spending or alternatively total income. And over the long run, it will anchor price. Over the long run, you won't have hyperinflation. But in the short run, it allows some variability in the inflation target. One of the examples I like to use is Israel. Since 2008, if you look at their nominal GDP, the level of total spending, it's been relatively stable. Now, this crisis, of course, is different. But for a decade there, they were doing it. Then if you decompose that and looked at real GDP growth and GDP deflator, which would be the measure of inflation, they were almost like mere opposites of each other, which is what you'd want. You'd want, when the economy slows down, some inflation to go up, and then vice versa. And we saw that in terms of the GDP deflator there. In my view, you want inflation flexibility in the short run while being anchored in the long run.
When it comes to nominal GDP, I guess there's a few critiques of it. One is that it's a big change. People don't like change. But the second one is around the quality of data, that the timeliness and the quality of CPI data is higher than GDP data. And then you have the issue of output gaps. How do you measure output gaps? There's more uncertainties around that all. Then I guess the third one is it's not in the language of central bankers as much, nominal GDP. So perhaps maybe a Taylor rule would be better, where you express the nominal income view through a Taylor rule, where you have some kind of output gap, unemployment gap, plus inflation in your equation, so to speak. So you're taking the two pillars together. What's your take on these?
So you're absolutely right on the first one. The first one, it would be different. There's no doubt. Change is hard, and it's especially hard for central bankers who are very conservative, small c. They're like trying to move a ship quickly, right? It takes forever to get to think differently. So I agree. That's why I do what I do. I have no illusion I'm going to change them overnight. I would mention this one thing, though. One of the challenges of doing inflation targeting as it's done in most advanced economies is you've got to tell people that sometimes you want to get higher inflation, like right now. And that's just a hard thing to sell. Tell the people who've lost their jobs, oh, we want to jack up inflation, They're like, well, why? I can hardly live, and you want to raise prices. And what they really mean is we're trying to raise spending and income. And as a result, there may be more inflation. And to me, it's like, why not just say, hey, we're trying to raise spending, we're trying to raise income. And you can do that with a nominal GDP target. So in some levels, I think it's easier to explain that to people than it is to, inflation. And to be clear, there'd still be challenges. I remember I talked to Paul Tucker, who's from your former deputy governor, and I was trying to pitch him on nominal GDP target, and he goes, "Oh, David," in his very fine British accent. He's like, there'd be so much confusion because people would look at the nominal income target for the country as a whole, and they'd say, "Well, my wages aren't keeping up," and they would be upset, and this wouldn't work. And that's true. There's idiosyncratic differences in what we get paid based on our productivity, based on our industry, a number of things. But that's also true for inflation targeting. I mean, when you ask people, what's happening to prices in your lives, many of them will say, oh, it's going up like crazy, even though inflation may be at 1.5%. They look at gasoline prices, they look at things, they ignore a bunch of other stuff. So this issue of a consumer, a person not mapping from the target onto the real life is going to happen no matter what approach you use. I just think on balance, it'd be easier to say, hey, we're trying to stabilize your income, or we're trying to stabilize your sales. So on your second question about data, this is the perennial problem. There are, I'd say, two workarounds to this. Number one is you target the nominal GDP forecast. You don't target the actual nominal GDP number. And I have a measure actually where I work at the Mercatus Center, where we look at a kind of a weighted moving average of forecasts, and we call that the neutral level of nominal GDP. And the way to think about it is people are making decisions all through their lives. You take it out in the US, at least take out a 30-year mortgage or a 15-year mortgage. I mean, you're having, as a household, making some implicit income forecast. And you want to account for that. And that's one way. So you look at measures of forecast, whether it's some aggregate measure. We have measures here also of household income forecasts. So that's one answer. The other answer is increased use of real-time data. One of the nice things about this crisis is I'm seeing more and more what I've been wanting to see, and that is, why don't policymakers use more real-time data? Arthur Terrell at the Bank of England has been doing a lot of interesting work on this too. But I know, for example, here in the US, JP Morgan's got data on this, but there's some researchers who are doing this who've provided real-time data on consumption expenditures. And it's supposed to replicate the C in GDP, the consumption part of GDP. And there's all kinds of stuff like that, credit card transactions. There's a lot of way to get this data. So if we really wanted to do nominal GDP targeting, I think the data would become endogenous to the regime. So we would find a way to get the data, whether through real-time data or through better forecasts. So I agree, in the present form, it'd be difficult, but I think we could get something to work if we really wanted to. All right, your third one was how to speak the language of central bankers. And yeah, maybe you do a Taylor rule. So I actually have papers where I have a Taylor rule, but it's nominal GDP in the terms as opposed to the other two. And in fact, it's easy to map from a traditional Taylor rule to a nominal GDP rule. You're just applying certain weights on inflation and output. One last thing, though, you mentioned potential real GDP. So when you set the nominal GDP target, one question is, what target do you set? And there's different answers to this. So this, I'm going to be honest with you, this is unsettled, but one answer would be pick what you want long-run inflation to be over the next decade, say it's 2%, and then pick what you think is going to be real GDP growth, all right? So we know real GDP growth, potential real GDP will change over time. What you can do with the nominal GDP target is to slowly adjust it over time as well. You need some kind of consensus estimate of potential real GDP as it slowly evolves. It's not going to change quickly, but as it slowly evolves, you just have to update your target. That would be another suggestion.
And kind of moving back to interest rates, there's a lot of debate amongst market participants around why rates are low. Is it because the Fed is there to buy lots of bonds? Is it to do with very low inflation expectations, for example? Is it to do with some kind of asset scarcity, safe asset scarcity? What's your take on why interest rates are so low?
Glad you asked this because there's been a very spirited discussion recently, been a part of Twitter and some other places. I've had some guests on my show. We've had this discussion. I mean, really, it's all the above of what you just said. So there's different questions. Why the secular downward trend over the past 30, 40 years? That's one question. Another question, what about here and now today? And so I do think people who take the other side of what I argue, people say, look, the Federal Reserve is setting the expected path of short-term interest rates, not just today's, but 10 years out, and that's effectively setting the entire yield curve. And so this actually would be this view would be an argument for yield curve control. The Fed's already doing it. Why not just make it explicit? And I agree with that statement up to a point. I think in a point in time, it's true. They do set their policy and they signal what they want to do. Sometimes, of course, the market doesn't agree with them, but they do have this ability to say, well, this is where we want to go, and next 2 years, we're going to have these rates. The problem is, if you think about how central banks actually operate, they say that at a point in time, but as data comes in and feeds through their Taylor rule, their reaction function, they're updating their path of interest rates. So while they do set an expected path of interest rates, it's always evolving. So the question then is, well, who's ultimately driving this path of interest rates? Is it the Fed itself, or is it the fundamentals the Fed's responding to? And that's where I would argue it's the fundamentals. I mean, the Fed's looking at a reaction function, a Taylor rule. He's looking at inflation, look at potential GDP. Both of those things are driven by the real economy, things that are going on, regulation, technology, demographics, all kinds of things. And I would argue that those ultimately drive the Fed's path of interest rate targets, given the Fed cares about inflation and full employment. I know people who take the other side would say, well, they don't have to worry as much about that. That's fine. But in the world we live in, I would argue the Fed's path of interest rates in the short term is being driven over time by what's happening in the real economy. Now, the other thing you raised was safe asset shortage. So there's path of short-term interest rates. So there's also the term premium. So we kind of have a standard theory for long-term interest rates. Are they equal to the expected path of interest rate, short-term rates, plus some kind of compensation for investors to hold longer-term bonds because they're a little riskier. They could lose money if interest rates change. And there, I do think you have to go to the safe asset shortage story. I think that part of the explanation is a better way to understand why rates have been going down across advanced economies for 30, 40 years. And there you can look at things such as globalization. Globalization has this dramatically increased incomes in emerging parts of the world. They're getting much richer, but their institutional capacity hasn't kept up with that income growth. So therefore, they go to advanced economies and take their securities. Also, demographics are playing a role in this. I think demographics, their portfolios are switching from riskier to less risky assets. Also, financial regulation, I think, plays a role in this as well. And then finally, I think we've had so many crises, there's some kind of baseline risk aversion that's being bumped up every time we have a crisis. And if you're a millennial, what is your defining experience? It's the Great Recession and now this. So you might be a little bit more cautious in your portfolio. And there's research from the Great Depression, and they call them depression babies, people who are permanently scarred by severe events in their life, in this case, the Great Depression. And I think to some extent, we may see some of that. So all those things, I think, suggest you could tell a story for the long decline from fundamentals of the real side. So there's short term, there's long term, you get them together, and I think you can flesh out a fairly interesting story.
And I guess the main thrust is that the Fed can't detach itself from the underlying fundamentals of the economy. If that's changing, then they respond to that.
Yeah, absolutely. If they care about price stability, they have to respond to the changing fundamentals. I mean, if they care about full employment, both of those things tie their hands. I think what happens is people miss the forest for the trees, to use an expression here. They get hung up on the Fed did say it's going to do something different, and markets responded. But they're forgetting that the Fed always says those things and always updates them based on what's happening.
And if you were omnipotent when it comes to central banking, how would you reform the Fed if you had to pick one or two things?
Okay, well, beyond the framework, we've already talked about where I'd go with nominal GDP targeting. The other kind of soapbox I've been on, a hot issue I haven't promoted as much lately, is the operating system itself, how the central bank implements monetary policy. There's the target, but what's the plumbing of it? And prior to 2008, kind of the standard approach was a corridor operating system, which would lead to a smaller, leaner balance sheet, all else equal. And I would go that direction. I just think it's better to have a smaller footprint for central banks. And it's also, I think, easier for central banks to work. It also has political economy implications. Let me just quickly describe where we are today. We have a floor system in the US, I believe UK. Most central banks have it. And what a floor system does is it separates the size of the central bank balance sheet from the actual interest rate target or monetary policy. So the central bank can expand or shrink its balance sheet independent of its stance of policy, which for central bankers is like, woohoo, this is wonderful, an extra lever we have. We're now more agile. But what it does is it invites temptation from politicians. Well, if that's true, if you can keep rates appropriate for policy and the balance sheet can expand rapidly, why don't you wipe all these bonds from my pet project? I think, going back to your earlier conversation, that's one danger. But I also just think it's a better system for the markets. One last thing, this is kind of a US thing, but just the design of the Fed, I would make the salary of the governors at the Federal Reserve Board more in line with the regional bank presidents. The regional bank presidents' salaries have blasted far past what a governor makes. So like Jay Powell makes a lot less than John Williams or even some of the, St. Louis Fed president and others, which is a little bad for incentives. If you want to work at the Fed and make the most money, you go to become a regional bank president. I would also try to increase the transparency how those regional bank presidents are appointed. I think there's some room for improvement there.
Okay, to be honest, I had no idea about the regional president salaries being higher than the board.
Yeah, let me throw some numbers out. These may not be completely right, but we have a paper at Mercatus, a working paper series. I'll send you a link to it by Peter Conti Brown. And he goes through and he documents, they used to be similar, but they've grown far apart. So I think kind of like the average regional bank president's around $400,000. Like Jay Powell may make closer to $200,000.
Wow, it's a huge difference. Yeah, you would not have thought that.
Yeah, and if you're a regular governor, it might be even a little less than that. And that's because, their salaries are set by their local boards. Those numbers may not be 100% correct. I think that's the ballpark numbers. And some, like John Williams makes, I think, well above that. But the point is, it distorts incentives. I mean, if you look, in fact, if you see governors don't stay that long at the board, there's a lot of churn there. It would be better probably if we had people committed to staying a little bit longer.
Now, if we go from the macro to the micro, I wanted to ask you some questions about your thoughts on supposedly smaller issues. One was on universities. And obviously with COVID and the lockdown, many universities have gone onto online. We're in the midst of colleges and schools reopening now. Some have decided to allow students to attend, others haven't. Lots of people are talking about, is this the big moment where technology really disrupts the education sector? You're at the Mercatus Center, which is at the George Mason University, and you're in the milieu of the education world. How do you see universities evolving here?
Let me say up front, I'm no expert on this, but I'll take a swing at it. I do think there is definitely room for improvement in higher education. It's one of the sectors, as you well know, that has not seen productivity growth in the U.S. economy over the many decades. It's the same approach that's been used before. And, I used to teach full time. Now I'm more of a researcher. So I understand the plight of professors, of trying to get tenure, of all those things. But I definitely could see a future where, just like we have superstar firms, where there's a few firms taking more and more market share, I can imagine a world where we see something similar with professors. There's superstar professors who have some version of, massive online open course where you can get credit at your local university, but the professor might be, the top teaching professor from Harvard. Now, there might be multiple. One might be teaching, macroeconomics. One might be teaching a history class. Different one teaches math. But there might be fewer professors, and the ones that do remain are the superstars, and they get paid a lot more. Maybe they focus more on teaching, less on research. There will always be some classes that you have to have in person, some hands-on labs, some science, technical stuff. But for some of these introductory level courses, I think it's plausible in the future, universities could save money by outsourcing to superstar professors. It's one industry where it hasn't happened. We see superstar athletes, firms. It seems like it could be the next chip to fall.
Yeah, I think you could be right. And at the more personal level, this is something I like to ask all my guests. Which book or books have influenced you the most in relation to how you see the world or your profession or how you live your life even?
Well, let me speak professionally. So I did not have a traditional economics upbringing. I wasn't even an economics major as an undergraduate in college. But I like to go to bookstores. And I did take some basic economics courses. And I really loved principles of macroeconomics when I took it. And I took a money in banking, and I just thrived at those. It didn't dawn on me at the time this could be a career. But later in life, I was working on a master in MBA, and I went to a bookstore and I was looking at books, and I bought a book called Secrets of the Temple by William Greider. And it's a popular account of the early 80s recession, Paul Volcker and his Fed. And it's written from a very populist, left of center view, but it's incredible details. One of these journalist accounts, they go in, they talk to people, they personal stories, really fascinating. And man, I read through that thing. It was just so mesmerizing. And I was taking another macro course in MBA program, and it really began to plant the seeds. Like, man, maybe I could do this for a living. This would be great. I really eat this up. So William Greider, he wouldn't, you probably wouldn't associate him with someone working at the Mercatus Center, which tends to be a little more rightist there, but it was a very interesting book, and I think it was a big hit during the time when it first came out. So that would be something that really helped me focus my attention on a career path. The other thing, going back to my hobby horse, nominal GDP level targeting, I first came across this reading a book by George Selgin, and the book was called Less Than Zero: The Case for a Falling Price Level in a Growing Economy. The argument is stabilize total demand and let prices go wherever the supply shocks take them. And if that means a series of positive supply shocks and rapid economic growth lead to mild deflation, he'd call it benign deflation, so be it. And so the argument of the book was we shouldn't worry about deflation unless it's the bad kind. But what I got out of it was, man, there's this regime called nominal GDP targeting, and it's definitely affected the rest of my career. So those two books I think were pivotal in my career in terms of interest.
Now, one thing I like to think about, and this is something at Macro Hive, we do a lot of curation, filtering of content. I mean, there's so much stuff that's out there, and much of it is free as well. Whether it's output from academia to bloggers to stuff on Twitter, books coming out, magazine articles, and so on. I mean, how do you filter all of that?
Yeah, that's a great question. I would say Twitter is my filter, believe it or not. I mean, Twitter can also be a distraction, but I try to keep Twitter strictly work related. Now, obviously it spills over sometimes to other areas, but I don't have many personal friends I follow or family stuff on there. It's all about, I follow people who are in my area, whether it's journalists, people like you, academics. It's a place where you get to really interact with the people who are talking to central bankers. In fact, some central bankers are on there. So you get both the access, but also you get what they think is the most important news of the day. And I found that very useful. So, I curate it. I make sure if there's something coming in my feed I don't like, I mute or I block it. And I only try to get those people, those institutions. I mean, Many of the central banks have Twitter feeds too, and you can, if they push speeches or papers out, you get them. To me, it's like a news feed as well as where they interact with the people who care about that. So I don't have access to a Bloomberg terminal, for example, but this is my Bloomberg terminal of sorts. I get my news feed, and it's really, I think, increased my efficiency in some ways.
And it sounds like you're quite disciplined around who you follow to avoid lots of noise and all the trolling and the dark side of Twitter.
And it's hard. I mean, honestly, it's hard. Sometimes because things get into your feed where you want to respond, like a political event, you're like, oh, I'm like, no, David, if I go down this rabbit hole, it'll waste my day, discussing some election. So I try to stick to central bank, and I try to, one, generally be nice and also be as generous and charitable as you can be when responding to someone. You never know what they're going through on that day, but also just keep it focused on topic. If I start talking about, and I'll admit, if you look at my feed, occasionally I retweet something from NBA basketball, but I try not to generally. I try to stick to Fed and macro and interest rate news and those things, and it does require discipline.
And finally, kind of, I guess, related to that, do you have any favorite productivity hacks? Because, I mean, I see you have a podcast show, you do research, presumably you do some teaching as well, management, administrative stuff. So there's a lot on your plate. How do you make sure everything happens?
There are two things that I like to do every day. I don't do them perfectly, but I like to start the day off with exercise and then quiet time to clear my mind. And for me, I'm a Christian. That often means prayer or maybe having a devotional, but it's also just thinking about what I got to do for the day and just what's important. But I find it's important for me, at least, to clear my mind through a quiet time and then exercise. And when I do exercise, I do a lot of running. I try not to listen to stuff, but I try to just go for a run. And I try to go for places where I'm running where I can lose myself in my thoughts. So, places I'm not going to be hit by a car, which is not always easy. But so that's what I do. I think these inputs are important to my productivity.
And how much time in the morning do you spend on the exercise and the quiet time?
Probably about an hour between both of them. I take about an hour, get up early, but it definitely, I can tell you, big difference if I don't do them. It really affects the rest of my day. So between exercise and quiet time, it's consequential. I'm willing to give up that hour because it is so wonderful. Now, again, I don't do it perfectly. I have 3 children. I got to race them to school. I got things around the house. The other thing is we've been working from home, right? And working from home is also distracting. There's always things to do around the house, projects you could do. So it's not always perfect. I'll be honest. I'm not a saint when it comes to this, but that's my goal.
And how do you switch off? Especially, I've noticed during the lockdown or the COVID period, it's even harder to draw a distinction between work and personal life. Do you have any thoughts on that?
I don't do it well. I mean, I do the best I can. Again, I got children, I got a dog, I got a cat, projects around the house. But I think all of us know we have things we got to get done, and we try to make lists for the day and look at the calendar for the week and try to work on them and get them done as much as possible. But I don't have an easy solution other than you try to draw boundaries and barriers. I do have a dedicated study in my house. That definitely helps. But even then, you can have kids storming into your study, Dad, help me with homework, or Dad, let's go baseball, So you got to, sometimes you got to say no and say, I got to work. Other times you take time off, but I'm not going to be the best example how to balance it. I'm still figuring it out, I guess is what I'm saying.
Well, I think on that note, we can sort of wrap up the conversation. I mean, we've covered a lot of ground, so I just wanted to give a big thank you. But also, what's the best way for people to follow you?
Yes, on Twitter, I'm at David Beckworth, one continuous word. And that's probably the best way to follow me. I tweet all my work and things that are important to me.
Okay, I'll add that in the show notes. So thank you very much, David. It was excellent having you on the show.
Well, thank you for having me. It's been a treat.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.